So the general rule of thumb is whatever your actually, it's not your mortgage, it's whatever your income is, should be 10 times the amount that you take in coverage. So if your income is, let's say, 25,000, the general rule of thumb says take $250,000 of coverage.
Hi, guys. Welcome to the Mortgages Made Easy podcast. I'm your mortgage guy, Dave Steinberg. And the Mortgages Made Easy podcast, we try to help homeowners address issues that they may face, whether they're buying a home or, in this case, how to insure your life so that if the unforeseen happens, you're covered. Steve is a great insurance guy. He's been doing this for almost 30 years, and he's going to help us understand what the insurance solutions available are to protect yourself if that, God forbid, happens. So, Steve, tell us a little bit about your story.
So thanks, Dave. So in 1997, I first became licensed, and my wife and I both had insurance on our lives. The unforeseen did happen in 2011, and the challenge that we faced was she contracted cancer and she passed away.
Now, I
Using
assume that would have been a huge challenge just paying the mortgage if you planned on counting on her income.
That's correct. And the challenge that I faced was, again, as you're correct, the lack of income. So using the death benefit from her policy, I was able to then pay off the mortgage, pay her final expenses, and still have a little bit left to live on.
Hmm.
So that's how I used the death benefit, and it faced the challenge that posed to me at the time.
Hmm. And so that's really important because I think a lot of people who are particularly first-time home buyers, maybe they're younger, they've never really thought through some of the uses of insurance. So let's start with the most simple and build up from there. So what kinds of insurance are available to that homeowner?
So based upon a homeowner's needs, there are different types. The basic type is something called term insurance. It is basic coverage, inexpensive for a term. So if
Okay.
you have a
So let's
30,
take each of those terms,
okay.
each of those phrases independently. You said it's basic insurance. What do you mean by basic insurance?
Basic insurance is it is only insurance, and it will only pay out upon death or
God
unfortunately
forbid.
death,
Yeah.
God forbid, and it will cover the mortgage.
Well, it'll cover whatever you're insured for.
Correct. Correct.
Okay.
There is no savings involved inside the term policy. It is pure insurance to pay off upon unforeseen the death. That
Okay.
is it.
So that's what you mean by basic.
Correct.
It's cheap. And what do you mean by cheap? It's cheap
It's
relative to
very,
other
it's
kinds of
very,
insurance.
it depends on age and your health. And
Mhm.
of course, the amount of coverage you're looking for. That's what determines the cost.
Okay. But it's cheaper relative to some of the other insurances we may discuss later.
Correct. Correct.
Okay. So you have term insurance. Now, I know when I first got a mortgage with my wife, we got a term policy for 20 years,
Mm,
which was more expensive than an annual term policy, but it covered us for that, God forbid, thank God we never had to use it,
good.
but term insurance, is available in lots of different flavors. So let's talk about that a little bit. Tell us about the flavors of term insurance.
The flavors of term, again, are based on the needs of the borrower or of the insured. There could be a 5 year term, a 10-year term, 20 or 30 year.
Okay.
The difference between those and an annual is if you have a multi-year term, the premium, the monthly payment stays the same.
Right.
If you look at an annual, then the premium or the monthly payment goes up every year.
Right. So the advantage of a annual is that it's probably cheaper upfront than a multi-year, than a 5, 10, 20. Because the 20, they're fixing the rate for a long period of time. But it has some advantages. So let's talk about those advantages, please.
Well, the advantage of a multi-year being less expensive over time is one advantage over an
Mhm.
annual. But
Okay.
also on an annual, there may be, based on the company that you use, there may be a requirement to prove that you are still what they call insurable. So if you get sick, they may say, sorry, you're no longer covered. Then what happens in the, again, unforeseen event that something happens to you? Now you have no coverage for the mortgage.
Right. And like everything else in life, most financial things, it's a give and take. There are some
Mhm.
advantages to a 1 year annual premium term life policy. You can get it relatively expensively, especially if you're fairly young. There lots and lots of options there. But, I would sort of tell most people, plan for a 10 or a 20 or even a 30-year term so you cover your basic needs. And then how would you determine how much insurance somebody should get?
So the general rule of thumb is whatever actually, it's not your mortgage, it's whatever your income is, should be 10 times the amount that you take in coverage. So if your income is, let's say, 25,000, the general rule of thumb says take $250,000 of coverage. Now that's a general rule. Then go the next step and determine the amount of mortgage you have. So in that example, 250,000 may not be enough if you have a $500,000 mortgage.
Hmm.
So again, it depends on your situation. In that case, if you have a $500,000 mortgage, I would suggest twice that. So 500,000 to pay off the mortgage and 500,000 for your partner, your family to continue living in that same house now without a mortgage so they can still live the same lifestyle you're accustomed to.
Yeah. And one of the things you said before really strikes me because some people don't necessarily factor that in carefully enough.
Mhm.
What you said was that you and your wife each took policies. Now, I understand sometimes, and I've had this conversation with people where, let's say, the husband's making $200,000 a year and the wife is making $100,000 a year, or the wife is making
Yeah.
200,000 and the husband's making 100,000. You may well want to insure both, but you don't necessarily have to have a million for the husband and a million for the wife. You can come up with a plan based on that, but really factor that in, and it's more than the
Mhm.
mortgage because, if there are children in the marriage, if there are lifestyle issues, you want to make
Mhm.
sure that you've talked about that. And that's where a financial um, consultant like Steve comes in, because he's not going to ask you about how much insurance you want. You're going to have a dialogue. So tell us a little bit about what that dialogue sounds like. What does it feel like?
The dialogue looks at things like, yes, the mortgage, but it looks at how much are your monthly expenses for food, clothing, the car payment, the credit cards. Do you want to save for the child or children for college? So all the expenses put together per month times 12 months is a year, times how many years would you like to be in a position without having to go out and, let's say, look for another job or have another source of income. So all those things put together determine the amount of coverage that really should be, obtained to live the same lifestyle.
Mm. I remember when my wife and I were just getting started building a family. We already owned the house, and
Mm,
when we budgeted for insurance, that's what we sort of tried to do. We said, okay, if over the next 20 years,
mm,
what will our how much would we need? What would the shortfall be if
right,
I predeceased? And that's what we did when we bought
mm,
our insurance.
right.
So let's go to the next step now, Steve. You talked about term being basic. There are other kinds of insurance like universal. So you want to tell
Mm.
us a little bit about that and how that works?
So one of the other policies that's gaining in popularity is called indexed universal life.
Okay. So
And
a lot of terms there to parse. Let's talk about what universal life is, and then you'll explain what indexed is.
so universal life policy is one that has cash included inside the policy as opposed to a term that has none. So when the cash is there, a universal life policy is typically tied to the market. So the value of the cash goes up or down. The
Okay.
reason the cash is important is that is something that the husband and or wife or partners, depending on how you want to phrase it, can tap into it and use for other things in case they have expenses or unexpected emergencies.
So the difference between term, which is a pure form of insurance,
Mhm.
term you're insuring against undesirable event,
Correct.
and universal is that universal has an investment component to it. Do I have that right?
That is correct.
Okay. So that what happens is um, you're going to, instead of taking, let's say your term policy would cost you $1,000 a year, you may be paying two or three or $4,000 a year for the universal policy. And what happens is the difference between that $1,000 and that two, three, four is that goes into an account to build wealth. And over time, the money in that account can become very significant.
It can become significant, but again, the key to a universal policy, it is tied to the market, which means the value can rise with the market or can go down with the market. So that's a gamble that somebody has to take. The insurance is still there, but the cash can go up or down depending on your risk tolerance.
Hmm. And where does index come in? What does index mean?
So the indexed is a different type of universal life policy, but the indexed piece of that says it is tied to indexes such as the S&P 500 index.
Hmm.
By doing that, you're getting the stability of the index. So you ride, or not you, but your cash rides up when the market goes up, but it does not go down when the market goes down. So the
Okay.
major differences between the two types are your risk tolerance. Do you
Hmm.
want to not lose any money? Because it's designed never to lose, and you still get the gains, which means your cash continues to increase. It will never decrease. That's the
Hmm.
difference between them.
Right. And then what happens at some point is that you've paid enough in, you no longer have to make payments. So term, you can have to pay that for as long as you have the policy. But
Correct.
it could be after 15 or 20 years of having a universal policy, you might build enough equity in that
Mhm.
policy that you're done. And then
Correct.
you have the insurance without having the downside of the
Correct.
uh, of the
Absolutely.
yeah. Now, one of the things that I like to talk about when we talk about insurance is that it doesn't have to be either or. It can be and. So, for example, somebody who may not have enough money at this stage of their career to really,
Mm.
they may not have enough disposable income. they may decide to take 50% term and 50% universal. And that way they get not the full benefit of either, but they get to start building the wealth and while at the same time they have the protection across the board.
Correct. Correct. And many families do that where income is limited. So they take the term, so they pay the lower amount of money and get a larger amount of coverage, and then supplement that with a universal so that they start to build the cash for their future.
Hmm, that's great. What else should people know, Steve? What else? You mentioned in our previous meetings, you talked about annuities. That's another way to protect yourself long term, isn't it?
Correct. Correct. Well, can I backtrack for just one
Sure,
second?
sure.
On the um, insurance, what people need to know is the cost of the insurance is based on your age and your health. So the younger you do apply and hopefully get approved, the less expensive it is. And those premiums do not increase
You're
because
saying on
what
the universal or
correct. Well, even on the term, if you take the longer 10, 15, 20 year, 30 year, your monthly premiums do not increase for that term.
hmm
If you're young and healthy, again, less expensive. The older you get, not only is it more expensive, but you risk that if you do get sick, maybe you can no longer be covered. So what
mm
people need to understand is it's insurance is best taken younger and healthier.
mm.
All
Great
right.
point.
All right.
Thanks.
So I just wanted to put that in there. So thank you for
Uh,
that. So to go back to your other question about annuities, what an annuity is in its simplest form is a set of payments that you will receive for the rest of your life. And when people say, I'm not sure, I always suggest, have you ever heard of Social Security? Well, Social Security is an annuity. It's called something different, but it's an annuity.
hmm
If you have a pension plan from your company, that's an annuity. So to create one for yourself, if your company does not offer it, that's a way for you to determine how much you want to put in and how much you want to receive at the end for the rest of your life. And there's all kinds of calculations which we're not going into because it's very, very complicated. We're not going to do that. But it's something that a lot of people want to have and need to have. And as we all get older and work our entire
You're getting older.
lives,
I'm getting better. Just putting it out there.
we are getting better. I didn't say anything else. I'm with you. We're getting better. Um, but when we do decide that we want to stop working and live the rest of our life, which is why we work so hard, we want to know that there is money out there as long as we're around so that we can still live the lifestyle we want. And that's what we
Mhm.
all want to do. And that's a great thing to
Yeah.
do.
And so you can take money, let's say, out of a 401k to buy an annuity, or you can buy an annuity with cash that you have today. And there are
Correct.
different ways of doing that. And there are advantages if you do a 401k, the money that goes into the annuity, I imagine, will be taxable coming out of the annuity. While if you're using after-tax money, then the annuity will be tax-free. Do I have that right?
Sort of. A 401k, which is pre-tax,
Mm-hmm.
does or can roll into an annuity.
Mm-hmm.
And when you do start to withdraw the money, it is fully taxable. The difference is an annuity will guarantee the income for life.
Mm-hmm. Mm-hmm.
If you take cash out of your checking account, savings account, wherever you take it from, it is already taxed. So you can put that into an annuity and that portion is no longer taxed. But the money that grows until you start take the money out, that portion is taxable. The
Hmm.
government wants their
Thank you
money,
for getting, yes, for
unfortunately. Uncle
correcting me on
Sam's a
that.
nice guy, but
Yeah.
okay.
Hey, Steve, this has been so valuable. We'll post your information with this, and I really, really appreciate you taking the time to educate us. And thank you
Thank
so
you. I
much.
appreciate the opportunity.
This has been the Mortgages Made Easy podcast. I'm Dave Steinberg, and we've been speaking to Steve Kent. Steve is with Universal Wealth, and he is really a guy who takes your financial well-being seriously. Thank you so much for joining us.
Thank you, Dave.